Nothing to see here. Put on the golf or something. What a morning. Live from New York City this morning. Good morning, good morning. Equity futures just about positive. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open, with Jonathan Ferro.
Live from New York, coming up, payrolls data in America coming in hot, leaving the door open to a 50 basis point rate hike, even as Silicon Valley Bank races to prevent a bank run. We begin with the big issue. It's jobs day in America.
We obviously get payrolls.
Non-farm payrolls.
50 basis points is very much on the table.
They're back to the pace being a tool.
Chair Powell opened the door.
They de-emphasized the pace, and then now the pace has come back as a tool they're using to manage inflation.
The Fed tightening has consequences.
The labor market is still strong. Inflation is sticky.
We don't think hiring can defy the gravity of Fed tightening forever.
There is clear labor hoarding going on.
It's taking longer for those effects to be felt.
They are not willing to let the lags play out.
We are now hanging on to every data print.
This is a data-dependent Fed.
I don't think the Fed has made their decision.
They're moving data point by data point.
The inflation report is going to be very important.
We've got so much to work through the next 60 minutes. I'm pleased to say that we kick it off with two all-stars, Mohammed Al-Arian of Queen's College, Cambridge, and BlackRock's Rick Reeder, with one eye on SVP, down more than 60% in the pre-market, halted with news pending. When we get that news, I'll bring it to you. Mohammed, first to you. Your response to that jobs data about 31 minutes ago.
Really tricky, John, and it highlights the fluidity, the unusual uncertainty, not just about economics and policy, but also what's being introduced by policy communication. This is a very, very difficult environment now. And I feel for Rick and others in the investment management industry that have to make decisions based on this.
Well, Rick, you get some sympathy this morning. I'm sure that's welcomed. What do you make of it?
Deservedly so. Listen, I think that, the number is strong. Listen, there's some governors on this. You take some comfort with the average hourly earnings coming down. We're coming off the boil in terms of hiring. But gosh, you look at these component parts, and we talked about it last month on the show. You look at leisure, hospitality, healthcare, education. You're still not where you need to get to in terms of fulfilling the job requirements or the number of people for those sectors. So you've got some durability to this employment strength, and it came through again this month. So like Mohammed said, you've got what is a solid employment report. You've got solid hiring in this country, and it makes the Fed's job tough.
In the immediate aftermath of that jobs report, Rick, it appears that we're trading on everything but the headline number. We're trading on a reduction in hours worked, an increase in the participation rate, wages coming in softer, unemployment up to 3.6%. Would you say that's the correct interpretation, the right move?
So quite frankly, I think there's some of that. I think that's more of, you got a little bit of whiff of financial instability in the last 24 hours. That's what's buoyed a lot of, particularly the front end of the yield curve, is people saying, gosh, long and variable lag may just have sped up a bit. You're seeing that play out. This is a pretty unique situation on the West Coast. That being said, it's illustrative of you've got to think through, how do you quickly slow down things like commercial real estate, residential real estate, et cetera? What's the impact on the system? I think that's a bigger factor than, quite frankly, what is a strong, albeit slowing in some areas, payroll report.
Mohammed, January 26th, you wrote for Bloomberg Opinion why the Fed should raise rates 50 basis points. They didn't. The Fed chair earlier this week opened the door to a 50 basis point move. And to Rick's point, Mohammed, we've now introduced some financial stability risk, and yields have backed away big time. So where are you now?
So, John, my view, because the Fed has been consistently late, the probability of a market accident and the probability of the Fed having to hike into a slowing economy and a recession is uncomfortably high. That is the reality. That is what happens when you fall so far behind. Rick is absolutely right. The marketplace is keeping an eye on too many market accidents and saying, you know what, the Fed won't have the guts to do what it needs to do for inflation. That is what you're seeing playing out, because parts of this employment report suggests 25, parts suggest 50. And when you've got that balance, you then look for a tiebreaker. And the immediate tiebreaker is what's happening in selected banks. Now, it's absurd, John, for me to say, of course, next week's CPI will matter a great deal, and that will be another tiebreaker. And it's absurd because we have become excessively data dependent. You and I have talked about this. There is no strategic or structural underpinning to monetary policy right now. So you've got a yield curve, the 2-year points, which is going all over the place. You've got expectations for policy going all over the place. And that is not how you conduct either a very important segment of the marketplace or policy.
Well, let's put some numbers on that phrase, all over the place. 2 days ago, the 2-year yield was 5.08%, and right now it's 4.73. That has truly been all over the place. Now, Mohammed, I think we're all really wary, super wary this morning about extrapolating out unique problems, unique situations right the way through the financial system. But are we seeing real signs of financial stability risk emerging?
Let me tell you what we're seeing. We're seeing that the correct statement that the banking system is sound as a whole doesn't mean that every bank is strong. We are seeing the correct statement that if you're a bank sensitive to both, and I want to stress both interest rate risk and credit risk, then you have a more difficult outlook. And then we're seeing the correct statement that that plays out in specific areas, and I'm really glad Rick rightly pointed to others. We've had a tremendous buildup of leverage in this protracted period of zero interest rates and liquidity injections, and keep an eye on these areas where you've had significant leverage build up.
So SVB is the bank in the news, Silicon Valley Bank. It was down more than 60%. It was halted pending news, and I can tell you that CNBC has reported that financial attempts to raise capital have failed. They're in talks to sell itself. And Rick, I can appreciate that maybe you can't comment directly on this single name, but I'd love your thoughts on what's been unfolding over the last 24 hours.
Yeah, I mean, so listen, we spent, early this morning, we were working through all of these, and yeah, obviously this situation and the tangential ones. And listen, I mean, I think there's some unique characteristics to this situation, which you've well chronicled. I think what you got to look at, all of these things have complexities today. I mean, commercial real estate is a tricky dynamic because, quite frankly, parts of it, multifamily is in pretty good shape, hotel and leisure is pretty good shape, office is difficult, Class B office is really difficult. So, you've got to, we're now entering a place where when you lift rates so quickly and the leverage has built in the system, you've got to look at where the problems are. In some places, where liquidity is actually in really good shape and you're in the right sectors, albeit you may have some leverage on, then you could work your way through it. But, this is, we're going to enter an environment, and I think when you think about asset allocation, you think about what you're doing as an investor, you got to get deeper today. I mean, to make some top-line perspectives on some things, you've got to get deeper. And I think, quite frankly, for the near term, you got to be a bit careful. We built some cash into the portfolios because you got to be a bit careful around some of this nuance and the complexity of some of these dynamics playing out, like Mohammed was talking about.
Rick, you and I have watched that evolution of that cash allocation of yours over the last 6 months or so, and every month you've given us an update. And I wonder if there's anything you're avoiding right now, choosing to avoid, de-risking from, and has that cash pile increased in the last month or so?
Yeah, I know it has. It's funny. We talked about it last month. That you had a window where it looked like inflation was coming down. We're pretty confident the economy's in good shape. We don't think the discussion of recession, deep recession was a really durable one. But the thing that changed in the last month was, gosh, the pervasive nature of inflation. You look at these core PCE numbers, the CPI, as Mohammed said, we got to focus on next week's data. And by the way, not just in the U.S. You look at European data. That changed the paradigm quite a bit. And all of a sudden, not only is inflation not coming down, in some places it's accelerating. So yes, we built a decent amount of cash. And quite frankly, some of the asset classes, if the Fed has to go further, if they have to go to 6, you do create a slower economy, you do create potential recession in 2024. High yield, not very interesting. Gosh, you could buy things like commercial paper at 5.5%, 5.75%. I'm looking at double B high yield at 7.25%. Why? You don't need to take the risk. So yes, we've reduced some of that some of that spread risk and say, you know what, I'd rather sit in commercial paper, treasury bills, and you're getting paid for sitting in the front end in a way we haven't gotten paid in years.
Rick, I saw you float the idea of 6 a little bit earlier on this week, and Mohammed, maybe we should take a step back and really think this through. Can you imagine a situation where we get a hot CPI print next week, put that together with a headline beat on payrolls, and this Federal Reserve on the data alone has to talk about increasing, going back to 50 basis points again at a time when you're seeing this kind of news in a financial system? Now, Mohammed, I get it, you get it, it's a unique situation. It's a very unique situation to this particular bank with a concentrated issue, with a lack of diversification around its funding. I think we all understand that. But when you see headlines like this, reports that this bank is in talks to sell itself, its attempts to raise capital have failed, down 60% yesterday, down 60% again this morning before it was halted with news pending. Mohammed, how does the Federal Reserve sit around the table and have a real conversation about reintroducing 50 basis point rate hikes with that as the backdrop?
So let me give you two economic arguments for why they should do 50, and then the qualifier. The first one, John, is very simple, is inflation has got stickier. It has gotten to the service sector. The longer they wait, the more they're going to have to do, the higher the peak rate. And you've heard Rick mention 6%. And you may end up with even more financial accidents. So that's the first economic argument for why you do 50 now, and it's why you should have done 50 last time, it's why you should have started earlier. Don't compound the mistake. The second argument is fundamentally understanding that you do not use one tool to meet two competing objectives. And if you use the monetary policy tool to try and meet two competing objectives, which is inflation fighting on the one hand and bailing out the banking system, which doesn't need bailout, by the way. A firm needs to get its act together, but not the whole banking system. But if you do that, you will fall in the muddled middle. So the economic answer is go for 50 and use other tools. What this Fed will do, I don't know, John. This Fed has surprised me so many times that the qualifier is that it's very hard to predict this Fed because they flip-flop all the time.
Mike McKee's our Fed whisperer. Mohammed, you know that. Mike McKee joined us now. Mike, you and I thought we'd be talking exclusively about the jobs report this time yesterday, and there's an extra wrinkle in the story now.
Yeah, there is an extra wrinkle in the story, and that's the banking system and the Fed's responsibilities there. But I don't think it's going to really affect their view of what they need to do on March 22nd, unless this gets to be something systemic beyond Silicon Valley. We do have, though, some news for them in terms of what they want to do for the economy, because we do have a strong economy, still strong labor market, 311,000 jobs created during the month. The January numbers revised down only to 504,000, so we're still seeing a lot of hiring out there. The unemployment rate, though, ticks up, and the participation rate tick up. Had somebody write in and ask why that is. Well, basically, more people looking for jobs, so more of them are out of work at the moment, and that pushes unemployment up. Average hourly earnings is the real story in terms of the Fed, because we've got an 0.2% rise, which is lower than anticipated and lower than last month, and the base effect 4.6%. The Fed will look beyond that, and they'll look at the 0.2, because if you look at what the annualized rates are, the 3-month annualized rate in February is 3.6%. That's the lowest since March of 2021. And here's the reason why. We're having a composition effect. Leisure and hospitality, the biggest gainer for jobs. Food services, 69,000 jobs. Those are low-paid jobs, and we're seeing also retail jobs tick up a lot. They're in the lower-paid sectors. Healthcare and social services also in the lower-paid sectors. Manufacturing is the highest-paid sector, basically outside of finance, and it lost 4,000 jobs. So the people who are coming into the labor force are filling the jobs. Rick brought this up earlier about jobs that are still open in sectors that need to be filled, and we're seeing basically that happen. The lower paid sectors are getting the jobs they need. Manufacturing overstaffed if the economy is slowing, and so that is maybe going to bring down some inflation, and it has certainly brought down the bets on what the Fed is going to do. The bet on a 50 basis point move in March soared to 70% after Jay Powell testified on Tuesday and Wednesday. It's now down to basically 40%.
There we go.
As people price this out. Now, the whole report is basically the John Ferro full employment report, because he's going to be here every day. You got to watch, because we got CPI next week. So we're going to debate whether the Fed is done or not.
Well, I think we can also thank the ticker SIVB for some of that reduction as well in the last 24 hours. Mike McKee, thank you for that. Off the back of all of this, we're down about 15 basis points on a 2-year to 471. It's not just the data, it's the risk aversion as well. We were as high as 5.08% at the front end of the curve just 2 days ago. Big reduction in that level. Equity futures really aren't doing much. We're down about 0.1% going into this opening bell in about 15 minutes time. Mohammed, I remember when you and I were going back and forth on this maybe 3, 4, 5 months ago. I think it was late September. We talked about the trilemma of a policymaker, and we were looking to the UK and the experience the Bank of England was going through. Do you get the sense that's an appetizer of things to come?
A small appetizer. It's, the policy mistake is not as pronounced as what the UK tried to do. And the LDI trade is very different from what we're seeing here in terms of SVP. But it just highlights that you can't ignore the implications for a system that got used to abundant liquidity and zero rates. You just can't ignore it. Again, it doesn't mean you make monetary policy hostage to it. There are other tools that you should be using actively. And it highlights once again that you need a better understanding, not just of the smaller banks as well as the bigger banks, but also of the non-bank sector. Rick, what's your take on this?
So, listen, I think there are a bunch of complexities around this. I think the central banks today, I mean, by the way, you throw out some of the other issues, as you keep raising rate, you not only create issues in terms of the financial system, you think about how the government, what fiscal policy can be going forward. We were doing a bunch of work on CBO estimates of how much the debt burden is going to be, the cost of servicing the debt, what it does to discretionary spending going forward. I mean, all these things are big, complex considerations. I agree. I think at the end of the day, I would go 50 as well. My guess is the markets are right, and the odds are probably not, especially given the news we just got. But like Mohammed said, there are other tools. You need to make sure that the liquidity in the system is ample. And listen, their primary objective today is inflation is running hot, and the reason why I threw out there's a reasonable chance they go to 6 is exactly that. I mean, inflation is hotter, not just in the U.S., and they have to react to that.
Rick, this phrase sufficiently restrictive, we throw it around a lot. What is sufficiently restrictive?
So, I often go back and think about this idea that you don't really know until you see it play out. And this is part of the idea around why I think the Fed will err on the side of doing 25s for longer, is you want to start to see how that long and variable lag works, how you're starting to see the dynamics play out. My sense is that you're getting to levels today, and it certainly played out in the last couple of days in some specific places, that you are going to see the slowdown. But the thing that is fascinating about this economy that's different than anything we saw 70s, 80s, when people look at those analogs, is you have an economy that's partially interest rate sensitive, and you look at, obviously, real estate, vehicle finance, durable goods finance. That has to be financed. But you have a big part of the economy. Where is CapEx today? It's not in structures. It's not in machines. It's in things like technology, AI development. Those aren't really interest rate sensitive. So this is part of why it's so hard to figure out what is the equilibrium rate today when you've got a very different economy.
Equal parts attention right now on the jobs report from about 50 minutes ago. And Silicon Valley Bank, SVB Bank, of course, the CEO was reportedly telling clients yesterday to stay calm. Reports suggesting that some of those clients were doing anything but. This morning, the stock was down by more than 60% again. Then it was halted, news pending. Some news, some reports. One report coming in the last hour from CNBC that capital raise efforts have failed. They're in talks for a sale. Kelly Lyons has more on this story down in D.C. Hey, Kaylee.
Hey, John, this has escalated so rapidly. Now it looks like they're trying to prevent a total bank run and an absolute exodus of client assets and deposits, but of course we're seeing the exodus in the shares, and it really is, to the conversation you three were just having, a question now of, is this an isolated incident of a bank that was heavily exposed to high-risk clients being tech startups, or is this a signal of something more systemic happening? Considering banks across the board all will have some exposure here to longer duration assets, government treasuries, which of course we have gone down in value as the Fed has hiked rates. There is reason, though, to highlight how SVB is unique. When you actually take a look at their investment portfolio, it's swelled to 57% of its total assets. Compare that to the other 74 competitors in major U.S. banks. None of them had higher than 42%. So that is one reason to maybe view this differently. But that does not necessarily mean the market is viewing this differently, because you are seeing the bleed through to other regional banks in pre-market trading. First Republic, of course, also heavily exposed to that tech client base after a 16.5% loss yesterday. It's down another near 25% right now in early trading. You have Zion, Signature, each down by double digits as well. And if you just take a look at the longer term, we know regional banks have been under more pressure than some of those larger, more diversified peers. Over the last year, the regional banks ETF down about a quarter compared to the broader financial select sector spider, down just 8.5%. Another way to look at the pressure is to look at the options activity. And when you take a look at open put interest on the regional banks, you can see that's at a record, a big spike on the white line. And again, SVB, the specific bank we are talking about today, is still halted with news pending. John, at the time of the halt, was down another 63% in pre-market trading.
Brutal stuff. Yesterday it was brutal. This morning it was brutal. Katie, thank you. And when we get that news, that update, I'll bring it to you. Overwhelmingly, the analyst community pretty much on the same page. Matt Mayo of Wells Fargo, Mike Mayo, saying this: SIVP is a worst case. The core issue at SIVB is a lack of funding diversification. They said most SVB deposits are from VC, which has its issues. We know that. To us, the larger bank, the more diversified the funding. You'll just hear that repeatedly. Heard a similar story from Betsy Grasick over at Morgan Stanley. We want to be very clear here. We do not believe there is a liquidity crunch facing the banking industry. The headwind for the banking industry is the cost of liquidity is high and rising. This is a headwind for net interest margins, revenue and EPS. As I've repeated all morning, particularly over the last 20 minutes, that stock is halted, news pending. It's down just before that by 62, 63% or so. Mohammed, a big question for a lot of people is, what on earth is defense in this environment? And do bonds start to work, given what we've been talking about all morning?
Well, they've been working the last 2 to 3 days. So, that's the good news, is that you have got some diversification because you've got flight to safety. So they finally have been working, but that is dependent on inflation coming down. If inflation remains a problem, if it proves to be really sticky, then the correlation that everybody wants for risk mitigation will unfortunately dissipate.
That risk mitigation story, Rick, for you, does that return in treasuries?
I always find the best way to manage risk is reduce your risk. Full stop. Take basis risk and figure out, like Mohammed said, you've got inflation accelerating, you've got a Fed that's moving. Yes, we have some duration in the portfolio. We think that makes sense. Where on the curve you hold that, I think is going to be important going forward. But listen, I always think the first stop. I always think about what hedges can you use, how expensive is it. Quite frankly, the cost of the rate hedge got more expensive with rates dropping. The cost of the volatility hedge became in the equity markets became more expensive. So, a lot of what I think about today is let's just reduce the corpus and then manage it more efficiently. Yes, you got to hold some interest rate exposure, but I don't think you should overdo it. And by the way, it doesn't mean all the U.S. as well. There's some interesting things in Europe where, you look at core goods inflation in Europe relative to the U.S., that hasn't come down yet. You could see that coming down. European duration is a way to hold it as well.
We've got about 3 or 4 minutes left together, so let's work through the next couple of days into next week and maybe into March 22nd as well. Mohammed, what would you look for through today's session as all of this news starts to pour through?
So I would look as to what dominates at the end of the day. I will also look as to whether investors recognize what Rick just said, which is that will be opportunities. 3 in particular. One is this is a very good environment for being selective. Secondly, balance sheet and collateral matter. And third, we will see overshoots. We will see good names getting short-term contagion. Like big banks, John, that have been negatively affected actually are going to benefit from what's going on. Guess where the deposits are going to go? They're going to go to the big banks. So it's important not just to worry, it's important also to recognize that there's important investment insights for the next few days.
I guess to some extent, important to have a plan going into the next few days as well, Rick. With hindsight, the benefit of hindsight, the entry point always looks obvious. I'm looking at high yield spreads wider over the last couple of days. We were neatly inside of 400 basis points, in and around 390 earlier this week. We're back to 417 again. When does that start to get a little bit more interesting for you, Rick?
I mean, I don't think we're there yet. I mean, there are, the compression of high yield to quality assets, particularly some of the assets in Europe when you swap them back to dollars. The compression is too narrow today. I still think you need significantly more for that to be interesting. I just think quality assets make a lot more sense. And if you believe the Fed's got to go further, you slow the economy down. I think quality assets will hold in a lot better. So I don't think we're there yet. I think the point Mohammed made is really, for as an investor, the most exciting thing that happens when you have a situation like this, the market paints things with a very broad brush. And we think about, what is the crux of the issue? It's an asset liability mismatch. Where are the places where your liabilities are durable that the markets have just priced those down? And so much of what we've been doing this morning is going through some of those financial institutions, banks and others, where you feel really good about it's not a liability dynamic and your assets are reasonably well protected.
Rick, I imagine you can't name those institutions, but can you describe those opportunities with a little bit more detail?
They usually move away from me when we do that. So, listen, I think some of the some interesting places in credit cards. I'll stop there. I think we're doing a bunch of work, and I usually hurt myself by talking more freely about it.
Well, I'll keep you out of trouble. I'll follow up on this one. You said you're not interested yet in high yield spreads at 420. The obvious response from me is, when are you interested? Another 100 basis points wider, 200? What's the level you've got in mind?
So yeah, I think it's dependent on where everything else moves. If it goes out 100 and investment grade goes out 75, still not there yet. But I mean, if you got back 100, 150, listen, I'm not worried about a big default cycle in credit. Companies have done a really good job at terming their debt out. Yep. The free cash flow is good, top line revenue. So I'm not that worried. I actually like it better that we talk about in Europe than I do the U.S. because you're getting paid for it.
I've got some good news for you. We're out of time, Rick. So the pressure's off. Rick Reader, that was great. To Mohammed, thank you. The two of you together, just absolutely fantastic, and what a morning for it. Thank you, guys. Coming up, more on SVB and a concerns grip in markets. Plus, we'll break down that payrolls report for you with Tiffany Wilding and Mike Collins. The last couple of days have been absolutely ridiculous. This morning, a good morning to you. Futures are negative 0.2% on the S&P. Chairman Powell reintroduced the risk and moving to a 50 basis point hike. We started to price some of that in. We've taken it all back. We're pricing in 25. How much of that is about the economic data from about an hour ago, and how much of it is about the risk aversion associated with select financial institutions in the past day? We'll have that conversation through the rest of today on Bloomberg TV and radio. There's your opening bell. Switch at the board and get to the bond market. Yields look a little something like this. Look at this. We're down 15 basis points on a 10-year, 375.63. The move on a 2-year, humongous over the last couple of days, from 5.08% all the way back down to 4.68. That is a 40 basis point move in 2 days. Down 20 basis points yesterday, down another 20 basis points this morning. Looking at the FX market, dollar weakness, euro dollar 106.50. We are positive there by 0.6%, and crude negative by about 0.1%. No drama, 75.65. The broader equity market down just 0.2% on the S&P 500. On the Nasdaq down 0.2 also, about 45 seconds into the session. Plenty of reaction to the jobs report from an hour ago. This came from B of A just a moment ago. We think it's a close call. We retain our forecast for a 25 basis point rate hike in March. Of course, that's highly dependent still on what we get on CPI next week, March 14th. It's in the diary, I know. Then on to March 22nd for that Fed decision. One stock to watch for all of you. It's SVB. Shares sinking for a second consecutive session before being halted. The CEO, Greg Becker, urged clients to, quote, stay calm during a call with customers. And Katie Lyons, things have been anything but.
Yeah, definitely not calm. Of course, we are still awaiting that pending news, John, but we did have the reports earlier this morning from CNBC that a capital raise has failed and the bank is in talks for a sale. And I was just checking in with a source close to banking regulators here in Washington who also said it seems fundraising talks have been a massive failure. Hence why you are seeing so much pressure this morning. Of course, the stock hasn't traded for some time now, given that halt, but at $39.40 at the last trade, this was a $267 stock on Wednesday. That is how quickly this has snowballed into what seems like a massive bank run. And of course, the concern now this morning, John, is does this bleed beyond just Silicon Valley Bank, which, yes, was heavily exposed to higher risk clients, VCs, tech startups? Or is this a signal of something more systemic, especially among regional banks that are less diversified and very exposed to an environment in which the Fed has aggressively raised rates and that bond portfolio has gone down significantly in value, John?
Kelly Light, thank you very much for that. Plenty of research coming through from the South Side. Morgan Stanley's Betsy Graysock said this, weighing in on the contagion risk for SVB. We want to be very clear. We do not believe there is a liquidity crunch facing the banking industry. The headwind for the banking industry is that the cost of liquidity is high and rising. This is a headwind for net interest margins, revenue and EPS. She went on to write, we do not expect that other banks in our coverage will need to raise capital. That is because we do not expect the same level of deposit outflows at other banks in our coverage. SVB is, of course, still halted pending news. The turmoil, though, pretty clear, spreading to the KBW Banks Index. That index is on course for its worst week since March 2020. Abby, it's been tough.
It has been very tough, ugly, in fact, John. And right now we have the regional banking ETF, the KRE, down more than 15% this week, similar to that KBW Bank Index, headed to its worst week since March of 2020 on what is really a flight on capital. And it's interesting because depending on who you talk to, it really seems to bring different views to light. Now, the idea that this is idiosyncratic to SVB, most likely not. It also has to do with the regional banks because, of course, when they were rich on deposits, investing them in securities, and now that you have clients taking out deposits, forced to sell those securities at a discount, and therefore the reason for the capital raise, that is not specific to just SVB. That will go to these other banks, and therefore you have First Republic down 31% today, PacWest also down sharply. But one reason that the big banks today are stabilizing to some degree, John, is they were forced to do this last year through regulatory capital. So this, what we're seeing now for these regional banks, where it was simply they're forced to market when it actually the loss is taken, it was done in advance for the big banks. So the big banks to some degree are a little bit more insulated. Nonetheless, you have all of these banking indexes down sharply, down more than 10% on the week, headed again to the worst week since March of 2020.
It's difficult to know what to do with this, isn't it? And Abby, thank you. About 4 minutes in, we're negative a third of 1% on the S&P. On the Nasdaq, we're down 0.4%. It looks like any other day until you look at the bond market. And the two-year yield's down 20 basis points. On top of the 20 basis point move we saw yesterday with a 2-year at 466 and a 10-year at 375, we're down 15 there. 2 days ago, north of 5% on a 2-year. Now the 2-year close to 450. Closer to 450 than 5%. Figure that one out. PIMCO's Tiffany Wilding has got to figure that one out alongside PGIM's Mike Collins. Deep breath, everyone. Tiffany, let's start with you. You have now an hour or so, 60 minutes to go through that payrolls report. Your thoughts, please.
Well, I do think that the banking sector stress is front and center here, and I think it's a good reason because the payroll report is frankly lagging. I mean, that basically tells us what happened last month, and we always know that the labor markets do lag broader fundamentals in the economy. You know, so I think from the Fed's perspective, really the question here is how tight financial conditions are getting as a result of this risk aversion, you know, stemming from the Silicon Valley bank stress. You know, I think the other issue here, obviously, is that even though, you know, I think the liquidity, you know, a potential liquidity crisis in the banking sector is, I still think the probability is that is low. It probably does cause some risk aversion, you know, with bank managers. I mean, are they going to start pulling back on the margin on credit, you know, start tightening credit conditions a bit more, you know, and that's basically doing heavy lifting for the Federal Reserve. So that just means the Fed doesn't have to do as much. So, I kind of agree with the markets here in terms of, you know, taking out the probability of 50 basis points.
So, Tiffany, we're saying that before we get CPI on the 14th. Are you saying that the bar for CPI to deliver or at least open the door to 50, case closed, is that really, really high?
Well, Well, I mean, obviously, the stress, some of the stresses that we're seeing in markets right now, it's a question of how persistent are they? If we're coming into next week and if people feel more confident this is an isolated case, you don't get the risk aversion, financial conditions aren't tightening as much, then certainly the CPI report, I think, will take more significance. But our own expectation for this report, is that it's kind of core CPI is going to be kind of where it was last month. And we actually do see some reacceleration potential, over the next couple of months as you have used car prices, that look like they're rising again, which has been kind of an idiosyncratic issue in the United States. So I think it's the bottom line is it's a tough job for the Fed right now. I think, they kind of set out a plan for going 25 basis points to kind of weigh the different risks. They don't want to tighten too much, but they don't want to tighten too little. That still seems like a reasonable plan for me.
Mike Collins, your thoughts on this one, please.
Yeah, Jonathan, a few big takeaways, I think, from the number today, then on the broader market conditions and the Fed. What we're seeing in the numbers today, and we've had some time to dive into it a little bit, you are continuing to see deceleration in almost every metric, from total payroll employment to hours worked, which are down 1.5% from the peak a few months ago, which is a lot on a big economy. You're seeing wages decelerate. Yeah, you have that mix shift, but we've actually looked at the leisure hospitality wages. They were running, Jonathan, on a 6-month rolling annualized basis, around 15%. A year and a half ago, they're down to about 5 now. So steady deceleration. Now, they're not at 3 where they were before the pandemic. And our guess would be that they probably don't get back to 3, that these wages, especially in the leisure hospitality services sector, where there's a massive shortage of jobs, continue to be sticky, but generally deceleration there, right? And the Fed, I mean, their MO has always been they keep moving, especially in an inflationary environment, Jonathan, they keep moving until something breaks, right? And they're so focused on this risk management policy, and there's 2 tails to the risk, right? One is inflation gets too high and they miss controlling it, and the other is something breaks, right? And I would argue the risk of something breaking is now tilting to be a little bit higher than the risk of runaway inflation.
Well, let's pick up on that because that's a really important point, Mike. So, Tiffany, there's 3 parts to this story around the Fed. It's pace, its ultimate destination, and its time spent at destination. Now, if you believe the Fed is destined to break something, can you draw conclusions about how long you think they'll spend at peak?
Well, I mean, I think if we, I don't think the Fed is destined to break something. At least I don't think that's what they want to do, right? They are trying to manage both of those risks, the risk of overdoing it versus underdoing it. And I think they're trying as best they can. But obviously things can happen in a very nonlinear way. When we look historically at payrolls, for example, how they behave after reaching their peak in a cycle, what you tend to see is that payrolls sort of decelerate kind of, nicely, if you will. And that's kind of what we've seen in this cycle. But then eventually they really start to deteriorate. And that's obviously when we go into recession. They don't sort of decline in a nonlinear way and then start to contract. They really just at some point ahead of recessions just plummet. And so it's understanding kind of when exactly that happens. And it's very difficult. So I do think the Fed's trying to manage that risk. The issue here is obviously that we still have very elevated inflation. Now, if we do go into a recession, obviously inflationary the inflation will likely come down, wage inflation will come down. So again, I think it's the Fed trying to manage these risks, just with the issue that, things can deteriorate in a very nonlinear way.
Look at this move at the front end of the curve. Mike Collins, we're down 28 basis points on a 2-year. That's 460, sub 460, 459. We were looking at 5.08 just 2 days ago. Mike, I was speaking to Rick about 20 minutes ago. I'm not sure how much of that conversation you caught. Rick Reeder of BlackRock, but he was talking about maybe de-risking a little bit, increasing the cash allocation again. Are you doing the same thing?
Yeah, I did listen to that interview, Jonathan. Thank you. And always like to listen to Rick and Mohammed's viewpoints. But yeah, we have actually come into this environment in a really de-risk manner in our portfolios. And we have really cut the amount of credit risk we're taking, partly to Rick's point. You're just not getting paid enough to really go deep into the capital structures. I mean, the more levered the companies, the more sensitive they are to higher rates and margin compression. And you're really seeing that start to bite increasingly across the corporate and real estate universes. So stay up in quality. There's a lot of excess yield and spread to be had up in quality. You're not getting paid enough to be down in quality. So that's step one. Keep the dry powder, wait for opportunities to add risk. And I think you're seeing that start to play out here. It's actually been remarkable how resilient, right, the economy's been, how resilient the credit markets have been. And I think it's really a testament to the private sector. I mean, throughout this whole pandemic and even today with higher rates, the private sector has adapted, meaning companies and people and businesses have adapted really well, right, to all these conditions. And when rates go up a lot, they kind of de-lever, right? And they look at their balance sheet more closely. They focus on debt reduction. And that's actually a tailwind for credit. So yeah, there's a lot of good credit opportunities out there, but generally you don't want to have a lot of risky credit bait in your portfolio today.
Mike, as you know, one man's resiliency is another man's complacency. And some people have said that high yield particularly is looking complacent. South of 400 basis points on a spread. We're now north of that level at 417. When someone tells me I'm not getting paid enough, Mike, I want to know what is enough. How much wider those spreads need to go before you get interested again?
Yeah, so let me put it in yield context just for simplicity, right? So we have a lot of portfolios we manage that are pretty high quality. Some have a duration of 2, some have a duration of 6. And some of these are yielding, in the 6s, close to 7%. Now, the high yield market is yielding, in the 8s. So, yeah, it looks like it's providing a little bit more. But remember, and we always advise this to our clients, when you buy high yield bonds at 8, you don't keep all of that 8, right? You do lose some of it to defaults. The default rate in the high yield market is at like 1 or 2 right now. It is going to go up to probably 3 or 4. Let's just say it goes to 4, which is about the historical average. That means you lose about half of that to defaults. You get half of that back in the recovery story when you go in front of the bankruptcy judge. So you lose 200 basis points annualized if that default rate averages 4. So that 8-handle yield turns into a 6-handle return, right? Which is very commensurate or comparable to what you're seeing in high quality parts of the market. And to talk about it in spread terms, 400, we're back to 420 on the high yield market. I mean, I think they have to be 100 wider. And I think we would be pretty aggressive buyers at those levels because, again, the fundamental quality of the companies in that market are actually pretty good right now.
Well, Mike, let's talk about some spread widening right now. When was the last time you saw a headline like this? SVB 2033 bond spread widens to 1,061 basis points. When did you last see that?
Jonathan, you see it when the Fed hikes policy, tightens policy too much, right? And you see the cracks start to come and you never know where it's going to be. I mean, I wouldn't have guessed it's the Silicon Valley Bank. And it's always that thing you don't guess is going to be the crack and the problem. And, you have this run on the bank risk out there. And there's so much debt out there in the world that investors own, from insurance companies to pension plans to banks to investors, that are underwater, right? That they have unrealized losses, right? And if you have to crystallize that, as is happening at Silicon Valley Bank, it gets to be really painful, right? The Fed has a lot of unrealized losses on their balance sheet, right? And I know Powell was being hammered on that in his testimony this week. I mean, so you do have to be careful about pushing too hard on rates and on tightening policy when you do have these underlying fragilities.
Mike Collins, perfect morning to catch up with you. Tiffany Wilding of PIMCO, just absolutely brilliant as well. To the both of you, thank you for working through some of these big issues. I can tell you, we had this massive move in the bond market, didn't see the corresponding move in the equity market until now, the last 5 minutes or so. We're down about 0.8 on the S&P. On the Nasdaq, we're down more than 1 full percentage point. And we have just got a monster move at the front end of the curve on both sides of the Atlantic. 2-year in America down 25 basis points, 462. Over in Germany, we're down 26 basis points. We've just broke 3%, 299. Kaylee Lyle's back with us for more. Hi, Kaylee.
Yeah, John, talking about the corporate credit market, you just said it. You are seeing serious distress now in SVB bonds. That 2033 bond spread now widening to 1,061 basis points. This feels quite chaotic. And of course, we can't look at the corresponding share move because indeed those shares are still halted in pre-market trading, pending news, which we are still awaiting. But at the last trade, it was down more than 60% in pre-market after a 60% decline yesterday. And of course, we've gotten reporting from other outlets this morning about failure in talks to raise capital capital. We now understand from CNBC that Silicon Valley Bank's deposit outflows are outpacing the sales process. This is the concern around a bank run here, John, that clients, including those that are with certain venture capital firms like the Founders Fund, are being encouraged to take their money out. And Silicon Valley Bank needs to come up with that liquidity. And of course, this is where it comes back down to those book losses realized now as they look at those treasuries that have gone down in value that they now have to sell at a loss. This is a bank that clearly is in serious financial stress. And some of that stress looks like it's bleeding, at least from a share price perspective, to other areas of the banking sector this morning, John.
Kelly Lyons, stay close. We'll come back to you a little bit later in the programme, hopefully. So we are about 16 minutes into the session. We're down 9/10 on the S&P, on the Nasdaq. We're down by 1.3%. I'll keep returning back to the bond market. Significant moves here. We're down 24 basis points on a 2-year, 463 on a 2-year yield. 45 basis points south of where we were just a couple of days ago. Just absolutely unreal. AMH down in Washington is going to join us now. Anne-Marie, the Treasury Secretary, has been testifying in the last 45 minutes or so. What are you hearing?
Yeah, John, well, so she's set to really just be talking about inflation and the risks of a recession, but potentially this is going to be something that's going to overshadow these questions that she's facing. What we've heard from the White House so far from a key economic advisor to the president, Bharat Ramarati, is he's saying that the Treasury Department is looking into this. It is quite really too early for them to see what the situation and exactly how this shakes out. They're calling it highly fluid situation, but they didn't want to say exactly what they could do in terms of this regional bank, but that this is something that they are looking into. And what one part was interesting from Mr. Ramarati is that he said, I don't want to say more than I can right now, but just to assure viewers it's something we are on top of. That's highly fluid, and what their concern is that if this would spread and to become more systemic. So don't expect any fireworks yet unless this was to become massively spread across the financial industry and the health of financial assets.
AMH, thank you for that. We're just going to work through some of the price action and bring you the latest headlines. A little bit early this morning, of course. Trading halted in SIVP, news pending. That stock was down by more than 60% earlier this morning in the pre-market, down some 60% in yesterday's session as well. We'll wait for that news. I talked about what was happening in the bond market. The SVB 2033 bond spread widening through 1,000 basis points. That signals, as you all know at home who follows this bond market, that signals real distress. No real signs of distress in the equity market, at least. It's a down day, sure, and it's getting worse. We're down about 1% on the S&P. On the Nasdaq, we're down 1.1%. The moves you're seeing in the bond market, though, let me frame them for you. They're absolutely phenomenal. So you've got Chairman Powell reintroducing the risk, opening the door to a 50 basis point hike, and that 2-year yield breaks 5, goes to 5.1%, just short at 5.08. And then comes all the way back down. Risk aversion yesterday, claims a little bit higher, I know, but the bulk of that move came in the afternoon. Down 20 basis points in yesterday's session, down 20 again today. On Bloomberg TV and radio, I'm pleased to say that joining us now is the US Labour Secretary, Marty Walsh, and he joins us from Washington. Secretary Walsh, what a morning for it. Just amazing moves in this market that we can discuss. Amazing moves on the West Coast with a financial institution. Secretary Walsh, you get to represent the administration this morning. I just wonder what your thoughts on what's been developing in the last 24 hours or so.
Well, certainly on the jobs front, we had a good day, but as you have been reporting for the last, I've heard you for the last 15 minutes, a lot of concern in different areas, and hopefully we can continue to move forward here. I know Secretary Yellen is up at Capitol Hill today testifying. There's lots of concerns about what the future of the stock market is. I know that, but when it comes to jobs, we have a good jobs report and good signs all along.
Are you worried that we're starting to see things break as the Federal Reserve tries to address inflation?
No, because we'll be talking about now, and people have been concerned about it for the last year, really. And when you think about what we're doing here, we're seeing jobs being added, we're seeing participation rate going up, we're seeing opportunities for even further participation rate by making some investments, and certainly we're seeing incremental steps in the inflation coming down. So we need to continue to stay focused on that.
And Secretary Walsh,
sorry, I froze there for a second because somebody behind me is talking, so it kind of got my head.
Don't worry, it's fine. It's the last interview we get to do together because I know you're heading to the exit too, so I'll give you the time.
I'm going to miss you. I'm going to miss you.
I'm going to miss you too, Secretary Walsh. I've got to fit a couple more questions in there if I can. We heard a little bit earlier this week from the chairman of the Federal Reserve. He took a lot of flack, a lot of heat from some Democratic senators, including Senator Warren, who said that maybe he was pushing this too far. It could lead to people losing their jobs. And he said, would working people be better off if we just walk away from our jobs with inflation of 5-6%? Secretary Walsh, how did you feel when you heard that interaction earlier this week? What were you thinking?
Listen, as I said from day one, my focus here is to get as many people back to work as possible and continue to see wages go up, working with business so business is successful. That's what my focus has been for the last 2 years here at the Department of Labor. That's been the president's focus, and we're going to continue on that path.
I know you're heading to the exit. Your replacement facing a little bit of scrutiny right now. You work closely with her. Secretary Walsh, is it a ringing endorsement from your side? Can you give her some words of support?
Absolutely. We've spent the last couple weeks, Deputy Secretary Sewell and myself, meeting with business, meeting with the U.S. Chamber, meeting with the Business Roundtable, meeting with the independent associations. So we're meeting with all those organizations just to talk about what the plan is here at the Department of Labor. We've been connected at the hip for the last 2 years. We work very closely together. Business, I think, has a very good feel for me as Secretary of Labor, and they'll have the same feel for Julie Su when Julie Su gets nominated.
Secretary Walsh,
gets approved.
We've got to leave it there. Thank you for your service, sir, and thank you for these monthly interactions. They've been fun. I've enjoyed them, and hopefully we get to catch up soon in your new role.
All right, thank you.
Thank you, sir. Secretary Labour Walsh there. Marty Walsh, of the Labour Secretary, of course. I want to come back to this market. Keen to do so for all of you. 22 minutes into the session, equities down 8 or 0.9% on the S&P, and the bond market just a monster move. We're down about 23 basis points on a 2-year. 4.64. I want to bring Katie Lyons back into the conversation. Katie, still halted, news pending, but we've got some news, haven't we, in the last 20 minutes?
Yeah, indeed we have. Of course, we've had the headline related to SVB's credit, the 2033 maturity, now seeing it widen by 1,061 basis points. We also have gotten reports, John, from other outlets about the sale process, because we understand that fundraising talks, raising capital for a Silicon Valley Bank has failed. They are now looking at a potential sale. And we also understand that now the withdrawal of deposits is outpacing the sale process. So this is a bank that is certainly in crisis. We are still awaiting confirmation of whatever that pending news may be. But at the time of the share halt, pending that news, this was a stock down more than 60% once again today after a 60% decline yesterday. We are now trading south, or we were, of $40 a share. This was a $267 stock on Wednesday. That is how quickly this has unraveled. What is happening here, as we are seeing now realized book losses for one of these banks that, of course, was smaller, of course, exposed to higher risk clients in VCs and tech startups. But there are still a lot of pain bleeding through to other banks as well that may have similar exposure, like First Republic, which is having its worst day since the financial crisis era, down by double digits, applying to other regionals as well. There is a lot of concern now about this health of the U.S. financial system, John, in the middle of aggressive Fed rate hikes, and a jobs report today that raises the question of how much further those hikes will go.
Kayleigh, in the last 24 hours, the analyst community has been very clear to draw a very, very bold, thick red line, black line, if you will, between what's happening with companies like SVB and what is not happening with the large banks on Wall Street. There is a clear distinction this morning. With Bank of America, let's pick a bank, they're down only 2.8%. Katie, are you seeing that distinction being drawn when you look at the smaller regional lenders as well?
You aren't seeing quite the same distinction. You definitely are seeing steeper losses for also tech-exposed banks like First Republic than maybe some of the other regional banks, but they are facing far more pressure here than their larger bank peers, John, and it does come down to that diversification. The narrative theory here is that those larger banks are not as heavily exposed so acutely to riskier areas. I mean, we have to consider this also as coming in the week of Silvergate, which was heavily exposed to crypto, also very high-risk clients. Now we're talking about startups that also are facing their own funding and liquidity challenges amid a changing macroeconomic environment. It is about the exposure here that is not as diversified, that is so specific, and it is affecting these banks to a larger degree. But, John, yes, you're absolutely right. It does seem, at least on the street, that they are really trying to make it clear that there is a distinction here, that this is not about some broad systemic risk in a financial system. It is just those that are exposed to a greater degree of risk in certain pockets of it.
First Republic getting hammered. That stock is down by some 51%. Kelly, thank you for that. The line you've heard, the phrase you've heard from Mike Mayo of Wells Fargo and others too, is a lack of funding diversification. I read this quote out earlier. I'll share it with you again. This is what Mike Mayo's got to say in the situation. He said, SIVB is worst case. The core issue at SIVB is a lack of funding diversification. Most SIVB deposits are from VC, has its issues. To us, the larger the bank, the more diversified the funding. That's the line you're going to hear again and again and again. I've heard it all morning. the whole of yesterday as well. Your broader equity markets recovering just a little bit. We're down about 0.75% on the S&P 500. At the moment on the Nasdaq, we're down a little more than 1 full percentage point. We've had a massive move in the bond market this morning. Had a big one yesterday too. We're down another 22 basis points on a 2-year to 4.65. Want to get you the trading diary just briefly. You will hear from the president a little bit later on, 10:45 Eastern. He'll meet the EU president a little bit later on as well. Pushing ahead to next week, Tuesday. It is the only thing that matters. It's CPI day in America. Then you get some retail sales as well. From New York City, that does it for me. If you can, enjoy the long weekend, or rather the next couple of days. This was the countdown to the Open. This is Bloomberg.